Howdy, y'all. Welcome to Liberty Call. Today is Tuesday, March 19th, 2024. Hope you're having a fantastical day out there in the interwebs. It is another beautiful day here in Colorado. Not too hot, not too cold. Still way too much snow all over the ground, but at least it's not falling from the sky at this point. So if it is your first time watching Liberty Call, if you could do me a favor, if you could give me some thumbs up, like, share, subscribe, follows, and press the notification bell. All right. Looks like the markets here domestically are in a good mood, not so much around the rest of the globe. Dow Jones today was up 0.83%, 320 points, closed at 39,110. S&P 500 up 0.56%, closed at 5178. NASDAQ up 0.39%, closed at 16,166. The VIX fell 3.56% today. It's at 1382. Canada was up 0.11%, Brazil up 0.45%, and Mexico down 1.21% for the day. In Europe, Germany was up 0.31%, the UK up 0.2%, France up 0.65%, the Netherlands up 0.81%, Spain up 0.99%, Italy up 0.95%, Switzerland down 0.39%, and Portugal also down 0.78%. Russian exchanges both read today. The MOEX down 0.96%, RTSI down 1.59%. And the Asian markets, the Nikkei was up 0.2%, Australia up 0.36%, New Zealand up 0.21%. Not so good in China. The Shanghai was down 0.72%, Shenzhen Component down 0.58%, China A50 down 0.35%, DJ Shanghai down 0.84%, Hang Seng down 1.24%, and the Taiwan weighted was down 0.11 for the day. So like I said, kind of mixed across the globe. The Asian markets not as mostly all red, and really happy here. So, all right, let's get to the market recap for today. U.S. stocks rise as Fed kicks off two-day meeting. Yeah, everybody's on pins and needles. What's the Fed gonna do? Please lower rates, please, Chairman Jerome. Please lower those rates. Which he's gonna come back and say, nope. All right, U.S. stocks. On Tuesday, U.S. stocks surged, buoyed by gains in energy stocks, coinciding with the commencement of the Federal Reserve's two-day meeting. Despite expectations of no change in interest rates, investors remain cautious, fearing a potentially hawkish message from the Fed due to recent inflation data surpassing the central bank's target. Data releases indicating persistent inflation above 2% have raised concerns among investors, prompting speculation of a reduced expectation for rate cuts this year compared to previous forecasts. In positive economic news, housing activity displayed signs of recovery as housing starts and building permits exceeded expectations. Tech giant NVIDIA received accolades from Wall Street after unveiling its latest AI chip at its annual conference. The launch of its B100 chip garnered praise for its potential to generate significant demand for NVIDIA's next-generation products. Spire Global saw a modest gain after announcing a collaboration with NVIDIA for AI-driven weather prediction. However, Supermicro's stock plummeted following its decision to sell 2 million shares to finance various operational aspects. Pfizer made headlines by reducing its stake in Haleon, while International Flavors and Fragrances announced the sale of its pharma solutions business to Roquette. Conversely, Nordstrom stock soared amid reports of the department store contemplating a move to go private. The energy sector led the market rally, supported by oil prices nearing 4-month highs ahead of upcoming crude inventory data releases by the American Petroleum Institute and the government. Key gainers in the energy sector included APA Corporation, Baker Hughes, and Devon Energy. Overall, Tuesday's market movements were driven by a mix of Fed meeting anticipation, positive economic indicators, corporate announcements, and fluctuations in the energy sector influenced by oil price dynamics. All right, so that's what's going on in the markets today. Let's go a little deeper into the housing. U.S. single-family housing starts and permits reach near a two-year high. In February, U.S. single-family home building experienced a significant rebound, reaching the highest level in nearly 2 years. The surge was propelled by mild weather conditions and a persistent shortage of previously owned homes on the market. Despite higher mortgage rates posing a challenge for first-time home buyers, builders have responded by lowering prices, offering incentives, and downsizing homes to mitigate rising material costs. The Commerce Department's report indicated a notable increase in permits for future single-family home construction, suggesting continued growth in the sector. With mortgage rates expected to gradually decline as the Federal Reserve considers rate cuts, the housing market could contribute positively to economic expansion in 2024. Single-family housing starts surged by 11.6% to a seasonally adjusted annual rate of 1.129 million units, marking the highest level since April of 22. This growth follows an upward revision of January's data, underscoring the resilience of the housing market amidst aggressive rate hikes by the Federal Reserve. Despite inflation concerns triggered by the central bank's monetary policies, the housing market remains buoyed by a severe housing shortage, with inventory levels well below pre-pandemic levels. Builders are optimistic about future sales, as indicated by rising confidence levels among single-family home builders. And here in Colorado, they are building like crazy. Out here in the sticks, out by the freeway where I live, there are communities going up everywhere, and they're putting them on these little teeny lots, big houses, little teeny lots. Who wants to live like that? Live out in the country like me. You get all this room and space and bears and mountain lions. I mean, yeah, that is the trade-off, but let's see here. In terms of regional performance, single-family home building saw substantial increases across the Midwest, South, and Northeast, while experiencing a decline in the West. Additionally, housing projects with 5 or more units saw an 8.6% increase in starts. Overall housing supply surged by 10.7% to a rate of 1.521 million units in February, surpassing economists' expectations. Building permits for both single-family and multifamily units also showed notable gains, indicating sustained momentum in the construction sector. The robust rebound in housing activity is expected to contribute positively to the economic growth, potentially offsetting previous quarters of contraction in residential investment. Economists anticipate a shift towards single-family housing construction amid a backlog of multifamily units under construction. While uncertainties remain regarding the Fed's monetary policy stance and inflation outlook, the housing market's resilience and expansionary trends bode well for future economic projects. Increased housing completions and growing inventory of under construction units are essential for bridging the supply-demand gap and alleviating upward pressure on housing prices and rental inflation. Well, that's one way to look at it. You could also not keep interest rates at zero for the better part of a decade, and you don't have these sorts of problems, but what do I know? All right, last up comes from Zero Hedge. This article is titled, There Goes the Fed's Inflation Target. Goldman sees the terminal rate 100 basis points higher at 3.5%. And what they mean by that is, their target rate has been like 2.5, whatever. They're thinking they're going to have to go up instead of, make the target rate like 3.5% moving forward, just so that the numbers continue to work, so they're not always raising interest. The key is they don't want to continue to raise interest rates because that hurts Wall Street and big business, and they don't like making their friends angry. All right, get my notes here. The Federal Reserve's ability to manage inflation, particularly in achieving the traditional 2% target, is increasingly being questioned by market analysts and economists. Goldman Sachs recently released a note challenging conventional wisdom, suggesting that both the neutral and terminal rates, akin to the inflation target are much higher than previously believed. Goldman predicts a terminal rate of 3.25 to 3.5 for this cycle, significantly surpassing the peak of the previous cycle by 100 basis points. The note highlights several factors contributing to this reassessment. Firstly, the fiscal deficit, notably larger than usual, could alleviate the short-term neutral rate by 1 to 1.5%. Secondly, the Federal Reserve's reluctance to tighten financial conditions adequately alongside rate hikes may further boost the short-term neutral rate. Additionally, forward market rates have risen. Model-based estimates of neutral rates have been revised upwards, and economic performance relative to the funds rate is being considered. Goldman anticipates a gradual adjustment in Fed officials' estimates of the neutral rate over time, reflecting both higher long-run neutral rate and the perception of currently evaluated short-term neutral rate. However, the exact landing point remains uncertain, as the economy's sensitivity to changes in the funds rate complicates the determination of the terminal rate. Nevertheless, Goldman foresees a terminal rate of 3.25 to 3.5 for this cycle, reflecting their belief in a higher neutral rate than currently acknowledged by the Fed. The note underscores the broader economic backdrop, including the staggering U.S. debt and the looming possibility of the Minsky moment. What do they mean by that? Let's Google that real quick and see. The Minsky moment. I hate saying something if I don't know what it means. The onset of a market collapse brought on by speculative activity that defines an unsustainable bullish period. So they foresee we might have some sort of a some sort of a collapse at some point. With options narrowing, such as potentially losing reserve currency status or resorting to massive debt monetization, Goldman suggests a shift towards inflationary policies. This would have significant ramifications, potentially reshaping markets' economic growth trajectories and social dynamics. As economists grapple with these emerging realities, the implications of raising inflation targets from 2 to 3% are profound. Non-fiat assets could become increasingly attractive amid a potential surge in dollar devaluation. Overall, Goldman's note signals a paradigm shift in economic thinking, prompting a reassessment of traditional monetary policy strategies and their potential consequences. So yeah, when you can't get inflation back down to 2%, just move your target up. Boom, problem solved. That's how the Fed does things. Just like government, they screw everything up. All right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening, and I shall talk to you again next time. Adios.